Today, we want to talk about a concept called mortgage versus home equity line of credit, and just showing the difference between a traditional mortgage and other ways of paying off our homes. So, I'm going to use some old numbers that I've used for a number of years, but if we were to look at a traditional mortgage of $150,000, most people look at paying that off over 25 years. Now, another interesting thing is that at one time in Canada, uh, the average mortgage rate was actually 8%. I know it's a lot lower than that right now, but the main thing is just to understand the concept. So if somebody was in that situation, their monthly mortgage payment would be $1,150 per month, made up of interest and principal. Now, I don't know if you have a mortgage or not, but what would you say is the biggest problem with a mortgage payment in those early years? Yeah, that's right. You could be paying as much as 90% towards interest and only 10% down on principal. So let me ask you a question. If you were able to change that ratio so more was going on the principal every month, could you pay your house off quicker? Of course, right? So let's now take a look at the other side and let's look at the line of credit strategy. So we're going to look at the same $150,000, same 25 years. Now, historically, we've always been able to get this at the prime interest rate, which at one time averaged about 2% below mortgage rates. So in this scenario, about 6%. And if you look at the rates today, they're pretty close to the same thing, but the concept still works because our main concern here is the ratio. The other big thing is when we get a home equity line of credit in place, if we want to, we can actually have that as an interest-only payment, which in this scenario would be about $750 per month. And at first glance, that maybe doesn't look like a great idea because if all you're ever going to pay is interest, how do you ever pay your house off? But what we've done here is we've freed up $400 per month. Now, the first option is to just treat this like a regular mortgage and say that $400 a month is going to go down on the principal every single month. And so a lot of times, just by setting it up this way, what you're going to see is that the interest portion of the payment will often become 60 to 65%, and the principal now 35 to 40%. So a lot more going on the principal. So just based on that alone, we should be able to pay off this property a lot quicker. Does that make sense? Okay, great. Let's go back to the traditional mortgage for a second. If we look at these dollars that we're paying to the bank every single month, have you ever stopped to think about what the bank does with that money? Yeah, they definitely make money on that, right? Especially the interest portion because that's pure profit to them, right? So if they're taking our money and they're making money off of that, how much of that return do they share with us? A bit of a trick question, right? They don't share any of it. But imagine if they did. Imagine if they shared some of that rate of return. If we took some of that, would we be able to pay our property off even quicker? Absolutely, right? So when we go back to the line of credit strategies side here, again, what we'll look at is that we only have to pay the interest. That's the only mandatory portion. So what we've done is we've given control of the principal back to the consumer. So technically, we can do whatever we want with that. But what we teach people is you could take that $400 a month and go hire a professional money manager to get your return on that money. In a lot of cases, it's the exact same money managers that the banks are using. So if they took that and invested it for us, over 25 years, if they were able to get us a 10% rate of return, that would actually grow to $530,000. At which time most people would say, okay, I only plan to have this payment for 25 years, so we have to go back and pay off that line of credit of 150. And then we also have to factor in some capital gains tax, about 30,000 here, which would leave us with about $350,000. Okay, so we got two scenarios here. Scenario one on the mortgage side, we're paying $1,150 a month. We do that every month for the next 25 years. And at the end, the house is paid, but how much extra do we have saved? Nothing, right? On this side here, it's the same $1,150 per month, same 25 years, At the end, we're going to pay the home off, and we have an extra 350 here. Okay, so a little bit better. Now, some people might ask, okay, well, what if you don't get that 10%? And I look at it and say, yeah, well, let's say you only got 5%, and let's say you only end up with $100,000 at the end. Are you still better off? Of course, right? But a couple other things that I like to point out. The thing that I really like about the line of credit strategy is the flexibility part. Because when we look at this traditional mortgage, let's say that we're out of work and we can't make those payments. What's eventually going to happen if we can't make that payment of $1,150? Yeah, I mean, they're going to take our house, right? Now, on the line of credit side, right, we only have to pay $750 per month. That's only mandatory payment again. So, it's a little bit easier to come up with. But same idea, right, is that if we can't make that payment at some point, they're going to come back and take our home on us. But the interesting thing here is, again, because we've given control of the principal back to the consumer, if we look at this couple years out, we've got about $10,000 built up inside there, which the consumer has control of. So if they were out of work for 3 to 6 months, if they needed to, they could dip into those savings in order to pay that interest payment every month, and that way they're not going to lose their home. Once they're back working, they just fire up the strategy again and away they go. So they don't have to be stressed out about whether they're going to lose their home and the bank's going to come back and get it. So I think that's pretty important. Okay, the other thing that I see is a lot of people just hate having debt. And at some point here, and on this scenario, it's about 12 to 15 years in where this money that we've been saving here, it grows to the 150,000. So technically, if a person wanted to, they could take that 150 at that time, pay out this line of credit, and be done with it. Okay, so essentially have their home paid off potentially 10 years sooner. So we recommend people that do that. We also tell them they should consider the very next day borrowing that money back out. And a lot of times people look at me like I'm crazy, right? But the idea is this, is that when we borrowed this money originally, it was either to purchase a home or to pay out an existing mortgage. And when we do that, this interest of $750, it's just a cost. But now what we've done is we've borrowed that money out specifically for investment purposes to try and generate income long term. When we do that, this interest now becomes tax deductible. So basically, just by shifting some things around, creating a paper trail, essentially what we've done is we've created an additional $9,000 a year in tax deductions for this family. Pretty good, right? And I always say, do you feel that you pay too much tax or too little tax? It's always too much, right? Now, of course, this strategy doesn't necessarily work for everybody, but this is one of the exercises that we put people through, is to see if there's something that could work in their situation. And there's a few different ways to do it. There's a lot of different options and a lot of flexibility with it. Okay, so if you're interested, we can run some numbers for you.